Welcome back to The Explainer. Today, we're putting Amazon through the absolute ultimate valuation gauntlet. We're going to step into the shoes of an expert investment analyst and test this $2.88 trillion behemoth using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. And then, we'll run it through modern discounted cash flow modeling. You know, it's the classic battle between present cash generation and future growth.
Right off the bat, we've got this massive, glaring conflict in the numbers. Amazon just posted a stunning operating profit beat of $23.9 billion for the first quarter of 2026. But at the exact same time, its free cash flow just plummeted into the negative, hitting negative $17.2 billion. Why? Because of a mind-boggling $43.2 billion in capital expenditures, largely for AI data centers. The market is definitely spooked by this. But are they right to be? Let's find out.
So here's our roadmap for today. We'll start with an Amazon company snapshot, then view it through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll run some modern DCF and multiples, and finally, bring it all together for a final recommendation. Part 1. The Amazon Company Snapshot. Looking at the latest CNB International data, Amazon is trading right at $263.04. That puts its market cap at nearly $2.9 trillion. It's an absolute behemoth, dominating e-commerce, advertising, and the cloud. And AWS growth, it's accelerating rapidly, up 28.4% year over year. The top line is just incredibly healthy, with total revenues clearing $181 billion for the quarter alone. Moving right along to Part 2, the Warren Buffett lens. So what would the Oracle of Omaha think? Well, Buffett absolutely loves a wide economic moat, and Morningstar explicitly awards Amazon a wide moat rating. He also demands consistent earnings growth. And we've got that too. Amazon's net income was up 31.1% in 2025 and is projected by CNB to grow another 24% in 2026. Management is honest and totally transparent about their strategy. They're heavily reinvesting for long-term AWS returns. But here's the snag: owner earnings. Buffett focuses intensely on the cash a business actually generates for its owners. And right now, because of that massive AI capital expenditure, Amazon's free cash flow is negative. Which brings us to the crucial question: is there a margin of safety here? For Buffett, without current positive free cash flow, he'd likely demand a massive discount to buy in. He requires a crystal clear margin of safety. So, while he might really appreciate the moat and the management team, at $263 a share with negative cash flow today, Amazon currently lacks his required margin of safety. He'd almost certainly be on the sidelines just waiting for the capex cycle to ease up.
Okay, let's switch gears to Part 3, the Peter Lynch lens.
Lynch would probably look at Amazon as a hybrid, somewhere between a stalwart and a fast grower. To value it, he leans heavily on the PEG ratio. That's the price to earnings divided by the earnings growth rate. So taking Amazon's projected 2026 PE of 29.4 and dividing it by an estimated 22.9% EPS growth rate, we get a PEG ratio of 1.28. Now, for a company with Amazon's sheer market dominance, Lynch would actually see a PEG near 1 as totally reasonable. That makes it a solid hold or even a buy in his playbook. And check out this ownership structure, because this is another huge metric for Lynch. He is all about companies where insiders have real skin in the game. Seeing founder Jeff Bezos still holding on to a massive 8.3% of a nearly $3 trillion company, yeah, that would definitely tick a major box for him. Insider confidence here is remarkably high.
Now brace yourselves for Part 4, the Benjamin Graham lens.
Running Amazon through Graham's classic defensive investor checklist is, well, it's pretty much a bloodbath. I mean, sure, it easily passes on adequate size and earning stability, but Graham strictly demands a dividend record, which Amazon doesn't have. He wants a moderate PE ratio below 15, Amazon is sitting at 29.4. He wants a price-to-book ratio under 1.5, and Amazon's is a lofty 5.4. Let's see how this builds into his exact formula. If we do the math, taking the square root of 22.5, multiplying it by the estimated $8.95 EPS, and then by the $48.71 book value per share, we get an intrinsic value of just $99.04. Graham literally wouldn't touch the stock anywhere near today's price. He'd demand an absolute collapse in the share price before he saw any margin of safety. Let's bring this into the 21st century with Part 5, Modern DCF and Multiples. To build our base case discounted cash flow model, we've got to look past the current capex spending spree. Teeker's Data frames this as a historic build-out phase for AI, very much like Amazon's original AWS build-out years ago.
So, we'll rely on their estimates that free cash flow will recover massively, turning positive in 2027 and reaching an incredible $176 billion by 2030. For the model, we'll assume a 12% revenue compound annual growth rate, apply a standard industry 9% weighted average cost of capital, and use a 3% terminal growth rate. Now look at the sensitivity table here, because this is wild. Our base case with a 9% discount rate and a 3% terminal rate spits out a fair value of $550. If we adjust to Teeker's exact mid-case assumptions, that pushes all the way to $668. But here's the kicker. Even if we are incredibly conservative, using a 10% discount rate and a mere 2% terminal growth, the value still sits at $420. That is still a massive potential upside from today's $263 price tag. The DCF model is basically screaming that the market is deeply mispricing the long-term cash generation of this AI infrastructure. To double-check our sanity, let's look at a few other models. CMB International applies a 17.6 times EV to EBITDA multiple to Amazon's expanding operating margins, which gives them a $305 target price. Morningstar, on the other hand, using their own models that factor in that whole $200 billion CapEx plan, sets a fair value estimate at $260, which, you'll notice, is right in line with where it's actually trading today. Finally, Part 6, Synthesis and Final Recommendation. All right, bringing the whole gauntlet together into one neat table. It is quite the spectrum, isn't it? On one end, Ben Graham's old-school value metrics heavily recommend avoiding the stock entirely, slapping a $99 target on it due to the high price to book and lack of current free cash flow. Morningstar views the stock as fairly valued, calling it a hold at $260. But as we move over the growth-adjusted metrics, the picture completely flips. CMB's multiple approach signals a buy at $305, and our modern DCF model, the one looking past this current CapEx trough, sees a generational strong buy at $668. So, as an analyst, how do we synthesize all of this? Basically, Amazon is making a short-term free cash flow sacrifice to secure long-term cloud and AI dominance. If you are a strict Graham-style value investor, you stay far, far away. But if you're willing to model future cash flows like a modern analyst, Amazon presents a truly compelling buy opportunity before that massive capital expenditure actually starts to monetize. So I'll leave you with this final thought to chew on. Do you trust Graham's math on the Amazon of today, or do you trust management's vision for the Amazon of tomorrow? Thanks for joining me on this explainer. Keep questioning the numbers, and I'll see you next time.